I'm not going to make you wait till the end of the video to reveal the best 5 stocks to buy right now or my top 5 ranked stocks to buy right now. And those are Nvidia, Amazon, Pinterest, Eli Lilly, and Uber. These are the 5 stocks I think are the best buys right now for long-term investors. Now, throughout the video, I'll discuss why I like these stocks, and as a bonus, I'll reveal my performance year to date in 2025 compared to the S&P 500 if you had picked my best stocks to buy instead of the S&P 500.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So, of course, valuation is an important step in my 6-step framework for evaluating stocks. And these 5 stocks I've chosen as the highest ranked stocks to buy right now, one of the primary reasons is because of an attractive valuation compared to the prospects the companies face in the future. The most expensive stock, surprisingly, is Eli Lilly, trading at a forward price to earnings of 34. And the reason Eli Lilly is trading at a premium valuation compared to its historical averages is because of the success of its weight loss treatments and the pipeline of new weight loss treatments and other treatments it has incoming, of course, in 2026. The big catalyst will be the pill version of the weight loss treatment the company is currently selling. The estimates suggest that Eli Lilly has sold roughly $25 billion worth of weight loss treatment, and demand for this market continues to increase. More convenient versions of the weight loss treatments will expand the market opportunity, make it easier for people to purchase these because the pill versions don't need to be refrigerated. It's easier to ship these products and store these products, so it will lower the cost of production and delivery, which would hopefully lower the cost for consumers and thereby open a bigger market opportunity. That's one of the main reasons I've been bullish on Eli Lilly stock this year, and it's worked out extremely well. Amazon, of course, hasn't performed extremely well year to date in 2025, but the valuation is attractive at a forward PE of 31.5. Amazon recently accelerated growth in the AWS segment. That's the company's most lucrative segment. It's the segment that houses its AI ambitions. It's the segment where the company has spent an estimated $125 billion on capital expenditures this year, and it's starting to slowly reap the benefits of those investments. This year, the stock underperformed, of course, because of the headwinds from the announced tariffs, but Amazon is responding well and adjusting well to those changes. And for those reasons, I've liked Amazon stock, and I bought Amazon stock for my own portfolio in recent weeks. The next stock I'll talk about is Nvidia. Of course, Nvidia is the most popular or arguably the most popular AI stock, and the company's revenue continues to soar, beating expectations nearly every single quarter. And surprisingly, it's trading at a relatively cheap valuation at a forward PE of just 26. I think that's a bargain, and that's one of the reasons why I ranked Nvidia as one of the best stocks to buy. I bought Nvidia stock from my own portfolio earlier this year. I got it at a great bargain. I bought around $93 a share. The market price has almost doubled since then, so I'm very happy with the performance of Nvidia stock. The next company I'll mention is Uber, which is also trading at a relatively cheap valuation, forward PE of 25.5. Uber continues to expand the market, expanding the number of monthly active platform customers, increasing engagement with each customer, and the company's cash flow from operations continues to soar as it demonstrates the power of its asset-light business model. Remember, Uber doesn't own any of the cars that are on the platform. Drivers bring those assets to the platform and Uber gets to benefit. The reason why Uber was trading at such a cheap valuation to begin 2025 and why you still have that opportunity today is because of the excellent job, I think primarily because of the excellent job Tesla has done at marketing driverless car technology. It made investors fear that Uber's business would be done for, would be out of business in a couple of years, and that created an opportunity for investors who have been paying attention to what Tesla has been saying and comparing it to what Tesla has actually been doing. The company's been in a habit of overpromising and under-delivery, and if investors were paying attention to that habit from Tesla's management team, you could have benefited from Uber's significant share price increase year to date, as I have, and I bought Uber stock for my own portfolio also earlier this year. And last but not least, Pinterest trading at a forward PE of 14.5. Pinterest stock price crashed by roughly 20% following disappointing earnings release the company reported. I was disappointed in that. Personally, I bought Pinterest stock from my portfolio about a month and a half ago at roughly $35 per share. So I'm down on that investment. It's my only stock pick in my list of top stocks to buy that's down this year, including ones that I had rated as a best buy earlier in the year that I removed from the list because the share price increased so much. Those have also all demonstrated significant share price increases. So far, Pinterest is my only loser in 2025, and I still like the value of this business. I think the recent quarterly underperformance was a one-off event due to the changes in marketer and business spending due to the increase in tariffs. Businesses adjusted their advertising budgets, expecting lower demand from consumers when they raised prices. And so that impacted the revenue for Pinterest. And I expect, and I'm reasonably confident that Pinterest will perform well going forward. So as I mentioned, there were a few stocks that I've removed from my list. And most recently, that was Alphabet, which I took off my list in November. Remember, Alphabet stock was up over 53% when I removed it from my top stocks to buy list. I had been recommending Alphabet as one of the best stocks to buy, and I own Alphabet in my own portfolio. I've owned Alphabet stock since 2020, so I'm really happy with the performance, but I think the performance was so great already in 2025 that I thought there were better valuations out there, so I removed Alphabet. And then a few months ago, I removed Oracle stock. Oracle was up over 53% when I removed it from my list of top stocks to buy, but it had performed excellently up until that date. I also removed DraftKings stock earlier in the year. It was up 29% when I removed it. And then AMD was also in my list of top stocks to buy. It was up 46% when I removed it from my list. Overall, my list of best stocks to buy has returned 32.86% year to date in 2025, and the S&P 500 has returned 17.3%. So my outperformance is nearly 2-to-1 to the S&P 500 index, 1.9 to be more precise. And so I'm happy with the performance of my best stocks to buy rankings. Pinterest has been disappointing to be sure, but the rest of the top stock picks have performed well. But just as a reminder, don't just listen to my recommendations and ratings without doing your own due diligence. Just because I've outperformed in the past doesn't mean I will continue to outperform. I recommend everyone complete their own due diligence before making any investment decisions. Hey, thanks for watching. I truly respect every viewer who takes the time to seek qualified financial analysis. Unfortunately, there are a lot of unqualified voices online giving unsubstantiated stock advice. My goal is to provide research that's grounded in data and professional training, not just what's popular. For those new here, I hold a master's degree in financial economics. I'm a CFA charter holder, an author, an adjunct professor of finance and economics. I've spent nearly a decade researching stocks professionally, and I'm here to help you make informed investing decisions. If you found value in this analysis, make sure to subscribe and consider joining the channel as a member for early access and in-depth members-only content.